Major funding for these programs is provided by grants from HSH NORDBANK and First American Title Insurance Company of New York, Perfect Building Maintenance, SJP Properties, Murray Hill Properties, Bank of America, Greenberg Traurig, Allied Partners. Additional funding is provided by grants from ARBOR Realty Trust, ANTARES Investment Partners, Athena Group, BRT Realty Trust, Burden LLP, CB Richard Ellis, City Habitats, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, Herbert J. Sims & Company, HERRICK FEINSTEIN LLP, Helmsley Spear, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, Kilroy Metal Products, MASSEY KNAKAL Realty Services, M&T Bank, Madison Realty Capital, Marcus and Millichap, Meriden Capital Group, McSam Hotel Group, NEWMARK Knight Frank, MOINIAN Organization, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sidney Fettner Associates, SHELDRAKE Organization, Stonehenge Partners, Studley, Triangle Services, Witkoff Group, Extreme Contracting and Deconstruction.
Hello, my name is Michael Stoller, host of the Stoller Report, Real Estate Trends in the Tri-State Region. We have a little credit crisis. That might be a nice, quiet way. And people are scared to lend money. Bankers are petrified. It's easier not to make a loan. So all of a sudden, there is a need for certain alternative or specialty lenders who many years ago when I was in their business would be called hard money lenders, or lenders, not lenders of last resort, but lenders who are out there to try to help you finance a real estate transaction. And today I've assembled four of the guys who are really involved with and are doing many of the transactions in the tri-state area and nationally. My guests today are Mark Zerlini, principal of Palisades Financial.
Howdy, Michael.
Jeffrey Gould, President and CEO of BRT Realty Trust. Greg Winter, Principal of W Financial. And last but not least, Josh Zagan, Managing Director or Managing Partner of Madison Realty Capital. Let's, you're the youngest. Otherwise, the rest of you are about the same age. But Jeff was saying prior to the show, his dad, who I've known and has been on my show, has said, this is the toughest time in real estate financing that he's seen in a number of years?
The credit crisis is just unbelievable right now. I mean, across the board, whether it's simple construction takeouts or into the merger and acquisition world, whatever it might be, it's the most difficult time that he's seen, and I, in the 20-some odd years I've been doing this, I clearly see the same.
And what do we attribute this? Well, I mean, what happened? I mean, was it those lousy CMBS guys, and I hate, because I don't like inside baseball, was it the Wall Street guys who couldn't sell their paper, or is it the perception, or what's caused this difficulty that people need alternative lenders, and it's good that you guys are out there to provide this type of financing? Greg?
I mean, there's no current market for there's no secondary market to be able to securitize CMBS deals. In the brokerage side of our business, I'm fairly shocked to see that even fully leased, well-located shopping centers are not finding ready lenders, except for some local savings banks that are stepping up to the plate. Strangely enough, though, construction lending is still fairly robust, as long as the properties are here in Manhattan.
But wait, that's construction lending. Is that for construction lending for condominiums,
in some
or
cases,
is that construction lending for new rental properties?
Both. Well-conceived condo projects that are sensibly priced in great locations, perhaps with the added boost or advantage of land that was acquired a while ago at a favorable price.
Can I ask you, what is a great location? I mean, for my viewers are in the 5 boroughs, plus, as you know, watching on the internet, people watch from around the world. What's a great location?
Well,
I mean, what?
Low
I mean,
vacancies.
Long Island, we were saying before, is not a great location. Parts of New Jersey, they're in the water with Hoffa, under the ground of the Meadowlands. What's a good location?
Well,
Jersey City?
On a sliding scale, if you look at, say, a couple of deals I'm working on, one in Brooklyn Heights, one in Cobble Hill nearby, relative to Greenpoint and Williamsburg and East Williamsburg, Brooklyn Heights and Cobble Hill is a great location. Everything's it has to be considered relative to alternatives.
Tell my viewers what you guys do. Well, what is a alternative lender? Somebody who's a direct lender who utilizes your own capital, your own lines of credit. What do you do?
I don't think we do anything different than the banks do. We can move a lot quicker than they do. We can look past some of the credit issues from the borrower. But again, you look to the sponsor who knows how to build, knows how to lease, knows how to operate. And you can get past, again, you might have some credit issues in the past, but as long as the property is something viable and it can rent and you can get a takeout, we lend on it. And we like to be short term.
Borrowers are sitting with deals and properties that they have to do things with. And in this type of environment where banks are not really too helpful right now, there's still things and there's still movement that has to be generated. So, for example, in this whole business with foundation work having to go in on 421 and having to get in before June and everything else, we were talking earlier, we're all flooded with that type product. There's always a need for a lender like any of us. And generally short term, if there's a non-conventional type of deal or in a situation like with this where there's just so minimal financing out there.
We're also not governed by the FDIC or certain regulatory agencies, which would generally take a lot more time to close a transaction. So that speeds things along.
I mean,
as
how
well.
fast could you? Let's say I, Mike Stoller, had this transaction. I found this property, in the good section of Cobble Hill, as opposed to East Williamsburg, and I found this location, and somebody couldn't do the deal, and it comes with plans, and I need X dollars. $10 million, $5 million, $3 million, and I came to you, and you liked me. I don't know why, but you liked me, you liked the transaction. How fast can you close this loan?
Generally 2 to 4 weeks is our time frame. And we're not shortchanging any of the due diligence than anyone else would do. It's just compressed, and we have a pretty flat organization.
We've done quite a few deals in 5 days, 8 days, and together, actually, Jeff and I just did a deal that was, I think the letter was dated February 1st, it closed February 14th. I would say what we all have in common, all of us sitting here, is we're like a SWAT team. We're like ninjas that are called into action for an emergency. Where we go to work every day is like an emergency room rather than a doctor's office. We're geared towards...
So you're a MASH unit.
Basically a MASH unit.
As long as quickly as you can get us title.
Sometimes deals are pretty clean though, and we can close deals. I mean, we've had closed deals in 2 days' time if need be. And again, not to take any additional risk, but we know markets, and whether it's the New York market or other states around the nation, and where we're comfortable, we can provide our financing very quickly. So it's not necessarily a master. You may have very good deals where just simple conventional financing fell out of bed, they retraded, where the borrower doesn't want to step in and take this deal that's now been thrown at them, rather close the deal for a short period of time and then go out and conventionally finance it more realistically.
But isn't it also, Jeff, not only the borrower doing that, it's the problem that perhaps the borrower had a term sheet or a letter from an institution saying, 3 months ago I was going to give you 80% of the cost of construction or 80% of the acquisition cost, and now I'm sorry.
Yeah, we've heard some very, very strange reasons why banks are trying to get out of deals,
Right.
and their bottom line is they don't want to do what they originally wanted to do 3, 6, 9 months ago. So the bottom line is this guy still needs to do something. This still needs to finance this product, and for guys like us, this is where we step in and kind of fill that breach.
And what do you charge? I mean, if a bank today, banks lend on either LIBOR or prime. A basis over there. A bank might charge prime plus 1, which would be 7 or something like that, and you will charge what?
We're LIBOR.
Shark.
We're LIBOR based, but just to kind of match our credit facility. So we go in with a minimum, Our minimums are typically 12, 13%, and no ceilings. And so it's LIBOR plus 10, whatever it has to be today.
And what about an origination fee?
Originations 2, 3, 4%, as high as 5.
How do you make that determination that you should charge 1, 2,
Whatever
3?
the market will bear.
Supply and demand.
Depends if you have a broker too.
We'll charge, our pricing ranges anywhere from maybe 10, 11% on a real strong quality deal, and a point or two upwards to 13, 14%. So there's some variation depending on loan to value and
Now
comfort level.
my question is, what type of size deals come to you? Is it $1 million to $20 million? I mean, you're a publicly held corporation, so you have lines. You can probably do very large loans. I mean, what's the size that BRT does?
We go up to about $45 million, so we'll write our own check for that without bringing in participants. And our average deal size is probably about $10, $11 million. We've been looking at a lot of 20s and 30s of late. We'll go as low as $1 million or $2 million if we can start a relationship with a borrower. And larger deals, which we have not typically looked at above that $45 million level, need be, we'll bring in participants to do so.
Josh?
Our range is really 1 to 50 million. That's on our balance sheet. We haven't done anything above that, and truthfully, we haven't really done a deal probably around above 30 million. That's our largest to date.
Greg?
We're most interested in deals between around 2 million and 15 million, because what we find is if a deal is 30, 40, 50 million, even if we were to put together a group of participants, we can't earn the same kind of yield that we can on the smaller product between 2 and 15 or 2 to 20 million.
I think our sweet spot's 3 to 15. I think our average is about 6 million right now. We try to keep it above, in that 3 and above range, because it's just as much work for a smaller deal than it is for a larger deal.
It's very interesting. I had the
hard.
president of Prudential Mortgage Capital, Dave Twaddock, on the show a couple weeks ago, and he said that they originated like 1,100 loans last year, and I was very surprised to hear that the average loan was like $10 million, as opposed to these mega deals that you would think of. That the Prudential feels much more comfortable, even though it does take as much time to do a small deal as a large deal. They like to mitigate their risk in that situation.
We spread the risk. Also, we try to stay away from all the larger funds out there, which are dealing with the 15 and 20. And if we can kind of find that sweet spot again in that 10 give or take range, we seem to get more business. And we're not competing all the time with 4 or 5 other funds.
So there's a real niche. I mean, and with the investment banks that were doing lending, I mean, they wouldn't look at deals under $25 million for the last number of years. So there was always that niche, below the $20, $25 million threshold that all of us could potentially look at. And that's still, I mean, the larger deals are there's more opportunity even with the larger deals today, but the smaller deals still, they don't want to play there.
But Jeff, you only do first mortgages, correct?
Yes, correct.
Greg?
We do first, we do some seconds in mezz very selectively.
Josh?
We do first and some seconds.
We do all 3, plus we do equity.
You provide equity, right?
I mean, the idea behind it, if you're doing, we're trying to provide first mortgage financing with a mezz component, so the combination of the two really brings you up to potentially 80% loan to value or something like that.
Now, that's today. How was it, when the banks were fluid and there was so much money out there? How high in the capital stacks would you lend before?
We wrote a number, the highest that we did was up in the 85% loan to cost range for construction mezz loans. Many of those were originated in March, April, May 2006, and are either already repaid or soon to be repaid at this point in time. In this point in the cycle, we're focusing mainly on first mortgages. And in order, from the flip side of our business, on the investor side, there are times where we could do a loan ourselves of, say, $12 million, but we choose to divide it and participate with some of our colleagues, so our investors have the best diversification in their portfolio. I know Mark and Josh have the same concerns.
Now, we said, what's an interesting deal today? I mean, Jeff was saying, and we were talking prior to the show, that there is a lot of deals that are coming to you people because of the change of the 421As, which really end in June 30th, which really end the end of April if you don't have your foundation in there in time. So besides the 421As, Well, I know you did a deal. You've done some deals in Jersey City. Tell me about your deals in Jersey City, because Jersey City is a great market. It's really done well. Condos have done well, rentals have done well because of the convenience and the transportation.
Right. Our deal was, we did a $26 million deal. It was roughly 50% loan to value, excellent location. In that particular area, they had rezoned that area to the Arts District for multi-use. So we looked at it as an office, as a rental, as storage. So there are many uses, and there was liquidity around this particular property, and we know a lot of developers in that particular neighborhood. So that helped in our assessment, but we believe we're in a good number there.
And besides that, what type of deals? I know I've seen a number of your transactions. What do you like? Do you like rentals? I mean, what are the group over here like? Is it rentals or condominiums? I mean, Greg was talking before. He had a very lucky deal with the Walgreens, which will happen once in a lifetime.
And that was 1031 tax-free exchange driven. The urgency there was a gentleman had a commitment from a major bank for a permanent loan on a brand new construction Walgreens outside of Miami. He had literally 8 days before he had to close the loan, and his bank fell out of bed. The bank, and this was at the apogee of the credit crunch in around September of '07. We were called in by the mortgage broker. We were able to get his loan closed in 8 days, preserving his 1031, which revolved around not only that property, but 2 other properties. So he would have had a huge tax liability. He closed with us and has just refinanced the loan maybe 4.5, 5 months
you bring
later.
up the Miami, and there are lenders today, including my own place perhaps, who might redline Florida or in general, unless it's a great borrower.
Not if there's a Walgreens guaranteeing the
No,
lease.
I'm not saying Walgreens. I'm
No,
talking.
we're down in Florida. We're looking in Florida. We're active in Florida. I'm actually speaking at a conference in a few weeks in Florida. I mean, a sister company of ours owns and operates property down in the area, so we know what's happening in the markets there. I mean, some specific, in Florida, obviously, you got to talk about individual cities to really understand what's happening, because it varies quite a bit from one city to the next. But we have a lot of involvement in Florida, and we're looking at deals in Florida right now.
So you like
pretty
Florida?
aggressive.
You're bullish on Florida?
It's an opportunity. I mean, clearly with the increased valuations that were down there, and now the problematic situation that's been so strong and so decisive, it seems to me like more or less that's a better opportunity in a lot of ways, and where buyers are finding a connection to some extent with sellers, because the realistic buyer-seller mentality is something that's leveling off, and there's transactional business starting to happen. Here in New York, there's still a disparity between what the buyers want as far as hoping to get some discounts, and sellers not looking at any sort of discounts here and in the general borough marketplace. There's just a disconnect, so there's really no transactional
What you're
business.
saying, and I'd like to, do you see do you see sellers of property being aware that it's harder to get financing, and have they come to the realization that their prices should go down, that what they expected, this is not 2006 or 2007, this is 2008?
Well, that's what I'm saying. Where is the question?
I think there's been a real, like a 6-month lag in the market, and started to set in recently, where I think borrowers start to understand and sellers start to understand what's going on, and sort of the liquidity crunch going on.
I was at a meeting before, and somebody said, land prices in New York City are still, in Manhattan, are still selling at $400 or $500 a square foot. And, construction costs are rather expensive and everything. They don't pencil out. I mean, how do you look at a deal? How do you, true, you're getting your reasonable yield for your risk reward, but how, what's your sweet spot? What's the best, or what are you petrified on? I mean, are you petrified? We were talking about the hospitality industry. The hospitality industry there's a dire need for additional rooms in New York City, probably in Manhattan. I'm not certain that there's a dire need for 18 hotels in Brooklyn, in downtown Brooklyn, or 5 hotels in Long Island City, or 3 hotels in the Bronx.
We don't get involved in hotels, so.
Why don't you get involved with hotels?
Well, we look at it as an operating business, and Just the hotel has never been our spot.
So what about restaurants? There are guys who are, in the financing business like yours who like restaurants.
5% of the restaurants go out of business in the first 2 years. Why would you want to get involved in those?
Hey, I'm just trying to create a little controversy.
We're underwriting deals that the borrower is claiming that it's going to be a hotel takeout. I mean, our underwriting, I think for a majority of us, the underwriting that we're doing is really primarily either, rental valuation, if you build it, what kind of returns will you get? Can you live with that return? A condo valuation as a residential sellout. But there are some very, very strong Manhattan locations, I mean, quality addresses that we're looking at right now because of the lack of liquidity.
No, right, but that's Manhattan. I'm really trying to get an idea.
We're not financing hotels in the boroughs at all.
Would
We
you,
haven't
Josh?
either, no.
Right?
Too many variables, too much complexity. We like to keep it simple.
Since you, I don't want to say, at one time there were people in your business who would loan to own. People would say, we'd make these loans because we really want to take back the property. That association that we spoke about before, these people really lent for that. I mean, you don't want to have that. You're a hedge fund. You have other things.
There's still people doing that. I mean, if Vornado makes a mezz loan, they're only doing it if they think the end game is it's a property they'd like to own at that basis.
That's why they took a $51 million write-off last week on their quarterly financial on Mr. McLeod's situation.
Oops. But I think the folks that are doing that aren't lenders like the group seated here. I think it's more real estate opportunity funds that are using the loan as a way into a property. If the deal goes sideways, they'd be happy
you have to
own
look at it as if you're going to take it back and develop it and finish it off, but that's not really the way we get involved. I mean, certainly you go in there to try to help the people to get to that next level, and I'd say 85% of the times we actually bring them to that next level and find a takeout for them.
Now, how do people find you? I mean, I have viewers over here, and the good part of the show is that certain people call me or email me saying, "I really learned something." How did I find an affordable apartment? How I found the loan? How do they find out about you? Is it 1-800-Palisades or Madison Plus, or W and BRT? I mean, what is the
Bergen Record article that everybody read this weekend? I saw my shining face in it, so that's one. But mostly they come from the professionals. Our attorneys are a great source. The architects. The accountants, I'd say about 50% come from brokers. Ones that are getting done mostly come direct.
For us, it's primarily the mortgage brokerage community. We've built up a business over now 28 years or so with a lot of repeat borrowers, which is probably 50% of our business. But the mortgage brokerage business and the mortgage brokers out there know us well. We do what we say. When we commit to something, we stand by our commitments. And more than anything else, is reputation. And you hear the stories about some lenders, none of us here to hear, but you hear some.
That's why they weren't invited.
Thank you. That don't do what they say. The bottom line is, I think it's just about reputation and word of mouth more than anything else.
And what about?
I would say the majority of the deals come to us through a network of mortgage brokers that my partner and I have cultivated over many, many years.
Similar places as we've just said, but we also have an origination staff of 15 people that are all out there looking for deals. And
so what do you have, these little munchkins going around?
Well, they're really marketing to the mortgage brokerage community. So we take a outbound kind of call model, and it seems to have worked over the last 3 years.
But I mean, if you had to say, this is, I don't want to use the biblical story because someone said to me, "How bad do you see the market?" And I said, it's like in the Bible, they said there were 7 good years and then there were 7 bad years. How long do you see this capital crunch having an effect on major lenders? And the liquidity crisis?
I mean, some of it comes down to when the CMBS market, or if it'll come back. That's taken a huge amount of liquidity out of the market. Another big problem has been the larger deals are just tough to finance. So really the financing today is really from savings banks or opportunity funds. I think it could last a year or 2 years. It's all.
I mean, you're the youngest of all of us here, but I'm just trying.
Well, it's been what? It was a 7-year down, let's say, from late 80s to mid 90s. It's been a 12-year up. So you're 7 years on, 7 years off. Is a little off.
No, I'm hoping.
Let's hope we don't have 12 years down.
No. Jeff, I'm not hoping that. All I'm trying to say is, somebody said, "Why was I taking the apple?" I wasn't going to take my crystal ball, but the real question is. You know, I remember speaking last year moderating a symposium for HSH NORDBANK, and I had two great keynote speakers. And at that day, the Fed cut their rate by 0.75%. And Marty Cohn and Bill Mack said, everything's going to be better. It was just, you know, lunch, everybody's happy, the world was going to be great, and everything happened. That was September. The market has only got worse. And I think part of the perception is not because of my show nor my articles, but I think a lot of this is that if you read the press each and every day, this is scaring the world even worse. I mean, oil prices, all of this other things. You know, I think that the great comment that I said to someone last week was the price of a bagel. That you know, it went up to $1.20 for a bagel, and you know, I said, you know, this is passed on. You know, and there was an article in the Journal today. People aren't using oil over there. I mean, where do you see this? I mean, if you know, if you do a construction loan or if you do a land loan, what happens if the person's not going to buy the condominiums? That's my problem.
That's the problem.
You know, that's the perception that I'm really.
There's no buyers out there right now because everybody's sitting waiting for the price to come down a little lower. Also, the banks, you know, going back to the 80s and 90s even, when everything hit the fan, the banks pull back and say, okay, let's look at our portfolio. Where are our concentrations? Is it in condos? Is it in retail? Is it in big box? Pull back, so it takes about 4 or 5 months for them to just assess what's going on, and they shut down the whole machine. So I think, what's going on right now, and that's a good opportunity for us.
Now, you know, just as an aside, I mean, people could invest on the market with BRT, which is a New York Stock Exchange company. Can people invest with you guys?
Certainly, with private equity. We have investors. Our minimum investment is $250,000. We'll take that and more. We're still open.
What about you?
We started with 20 investors to just accommodate business that was coming to me through my mortgage brokerage firm. That was in 2003. It's grown up to over 120 high net worth individuals. Many principals of large hedge funds personally invest in our fund and would like a look at participation opportunities. We're just about to launch a second class with $1 million and up requirement. So we're open for investors.
And you, Josh?
Well, we started in May 2005. It was $12 million of individual money, and from there it's been all institutional money. We have it's $250 million of equity today under management. It's been all you know, fund of funds, family offices, endowments.
So I think, you know, in essence, what I've got out of this is, you know, there are alternative lenders who are out there who are not, I will make it, and I said that's why the four of you are here, because not who want to make a loan and do a good deal for somebody. But I think in today's market, I think people can be aware that the banks are difficult, the credit crisis is there, that our word may be around, I hope I don't call it, and that they should know that there are alternative lenders who provide an excellent service, and I'm happy that I've been able to have 4 of them today. Mark Zellini of Palisades Financial, Jeff Gould, who's been here before a number of times, President and CEO of BRT Realty Trust, Greg Winter, Principal of W Financial, and last but not least, Josh Zagan. Next week, we have some real estate investors who are going to give me their perspective on what the market looks like. See you next week.
Major funding for these programs is provided by grants from HSH NORDBANK and First American Title Insurance Company of New York, Perfect Building Maintenance, SJP Properties, Murray Hill Properties, Bank of America, Greenberg Traurig, Allied Partners. Additional funding is provided by grants from ARBOR Realty Trust, ANTARES Investment Partners, Athena Group, BRT Realty Trust, Burden LLP, CB Richard Ellis, City Habitats, Citi Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, Herbert J. Sims & Company, HERRICK Feinstein LLP, Helmsley Spear, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, Kilroy Metal Products, MASSEY KNAKAL Realty Services, M&T Bank, Madison Realty Capital, Marcus and Millichap, Meriden Capital Group, McSam Hotel Group, NEWMARK Knight Frank, MOINIAN Organization, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sidney Fettner Associates, Sheldrake Organization, Stonehenge Partners, Studley, Triangle Services, Witkoff Group, Extreme Contracting and Deconstruction.